It's Jackson Hole Week, and the Fiat Federal Reserve has announced its rate-cutting cycle pivot.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions.
Fiat Fed Chairman Jerome Powell cites rising unemployment as a key reason for kicking off this cutting cycle. This is the same week the U.S. government data rigging Bureau of Labor and Statistics admitted they've recently overstated U.S. job growth this year through March 2024 by nearly 1 million phony job hires. This is the largest admitted job rigging number since we were in the heart of the global financial crisis stock market bear bottom in 2009. How large will the first rate cut be on September 18th? It's hard to know. What we do know is the last two times the Fiat Federal Reserve cut rates into escalating unemployment numbers, the U.S. economy ran through deep recessions and massive stock bear market crashes in both nominal terms and in terms of valuations versus silver and gold respectively. Both the 2000 stock bear and the 2008 stock bear cycles were followed by massive spot price and relative valuation rallies for silver and gold. Not coincidentally, former silver bullion bull Warren Buffett's Berkshire Hathaway has increased its cash hoard to the highest level it has ever stacked. Nearly 1/4 of all their assets are in cash, likely awaiting to deploy said cash after the next U.S. stock market bubble crash has arrived in full. So how far up the chain is behind-the-scenes coordination going on in order to help quell the coming financial instabilities? Well, supposed enemies, China and the United States, agents within the PBOC and the U.S. Treasury have been signing deals on bolstering coming collaborations for managing periods of upcoming stress. So what does the uncommon man on the street increasingly know if they have dared bother to look?
Excuse me, sir. Question for you. Have you ever been broke before?
Why do you ask that?
I started a channel.
What's
It's a mic. I started a channel at the University of Texas in Austin. I grew it to 7 million followers, and I don't
Yeah,
have.
I've been broke.
Yeah.
Yes.
What did you do for a living?
I was in Wall Street.
And what did you do after Wall Street? You
I'm still doing it. I
You
manage
were.
money.
What was the most amount of money that you ever made in a single year?
It was income.
How much was that?
14 million.
$14 million. What is one lesson about money or business that you would give to somebody that they will not learn in school?
Okay. It's very simple. Believe nothing that you hear and only half of what you see, because the other half is an illusion. And that's the most important thing I could teach somebody.
And in your opinion, what's the best industry people should be looking to get into in today's world?
Gold.
Gold?
It's gold.
Why is that?
In January of 23, the central bank for all central banks in the world came out with Basel III, and it put gold as a tier 1 legal asset in the global banking system. There's 3 legal assets, tier 1. There's cash, sovereign bonds, and now gold. So gold is where you want to be.
Central banks increasingly know this and have been buying gold bullion in record amounts over the last 2.5 years. And while sovereign nation gold bullion reserve buying and building has been mostly an Eastern phenomenon since the 2008 global financial crisis, even Western nations like Poland are admitting they're targeting to own a 20% allocation to physical gold bullion for their liquid sovereign savings long term. That basically mimics what the Russian Federation already achieved and has been maintaining since the 2020 COVID crisis. As the world increasingly wakes up to the fact that the bullion over bonds trade era has indeed arrived in full, all they really have to do is look at collective central bank balance sheets to confirm this. In a world awash with an estimated record high $315 trillion in debt to the tune of 333% of global GDP annually, the typical answer to such heavy debt loads, historically, is to devalue the underlying fiat currency units owed. One reason for such record central bank gold buying over the last few years is just that. When we look at the world's central bank reserves throughout this full fiat currency era, the proliferation or the addition of fiat currency reserves gobbled up in the 2000s and the first half of the 2010s stands out if you stare at the red line there. In order to offset the coming losses on those fiat currency bags, central banks have been front-running and reducing their exposure to the fiat US dollar thus far in the 21st century. But most importantly, they've been adding to their gold reserves on net, especially so in the last 2.5 years. And while central bank gold buying has been growing increasingly so since the 2008 global financial crisis, in order to offset the coming losses on their devaluing paper fiat currency holdings, the spot price of gold is going to have to multiple many-fold from here as the years and decades progress. If we take the long view on central bank gold reserve ownership, the recent surge in buying since the 2008 global financial crisis is really but a blip on the radar. What is most important to remember is that as gold gets re-rated higher over time, it will again prove itself to be the very foundation of all things financial, globally speaking. This current gold bullion bull market price breakout beginning in October of last year, 2023, if we simply analog it or match it against the prior bullion bull market runs in gold, it's calling for dramatically higher spot prices in the coming 3 years. So yeah, the uncommon man on the street and I both agree.
So gold is where you want to be.
On the other side of this break, we're going to talk specifically about the spot gold-silver ratio and the building bullish fundamentals for silver and its globally decoupled price signals and how they are likely to make this the greatest silver bullion bull market the world has ever seen. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates. And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
Make some room in your safe because a whole lot of silver could be coming your way. SD Bullion's Monster Box Sweepstakes is back, featuring 500 of SD Bullion's very own Silver Tree of Life coins in a Monster Box for the first time ever. This stunning silver coin is a highly detailed masterpiece featuring a hidden inscription on one of the tree branches that changes every year. So put on your best flannel and become one with the forest, and take your shot to win 500 silver trees from SD Bullion, because someone's gonna win it, so why not you? Click the link below for your chance to win.
The spot silver and gold markets traded up to close on the week's ending news of the Fiat Federal Reserve's interest rate cut cycle pivot. The spot silver price closed just under the nose of 30 an ounce. I'm sitting here wondering how long it's going to take China to blow again through the old Ralston-Benham-Tamp line, perhaps very early next week. The spot gold price closed the week above 2,500 an ounce again. The spot gold-silver ratio fell to close the week at a still high level of 84. Speaking of the still historically elevated level of the spot gold-silver ratio, here's a quick clip by the COMEX CME Group on why the historic ratio means much to traders in a bullion bull market especially.
The gold to silver ratio is a closely watched metric that offers insights into the relative value of gold and silver. This ratio is calculated by dividing the price of gold by the price of silver. The ratio has historically demonstrated cyclical behavior reflecting the underlying economic conditions. The current ratio of near 90 historically means that silver is underpriced compared to gold. Over the last 60 years, we have seen the ratio hit a low of 15 and a peak of nearly 120 during the COVID crisis. The average sits between 40 and 60 to 1. As gold and silver prices continue to be influenced by a complex interplay of supply, demand, and broader economic factors, the ratio's behavior provides valuable insights into potential market movements. With both metals showing strong bullish signals, especially with the likelihood of rate cuts around the corner, silver could be set up for a significant run compared to gold if the long-standing ratios return towards their mean.
The spot gold-silver ratio throughout this full fiat currency era has bottomed as low as 15 in early 1980 and ballooned as high as Great Depression levels, above 120 during the 2020 COVID crash. Pretty much since the 2011 price high for silver in the early spring, where the spot gold-silver ratio bottomed out near 30, we've pretty much been in a rising channel back towards 1990s silver bear market levels. At some point, this ratio will roll over in earnest and begin tightening, And it's conservative, I think, that ultimately before this building gold silver mania phase peaks out globally, we're going to fall below the old 2011 low of 30 and perhaps back towards what we saw in the late 1970s and early 1980. After all, this bullion bull market is not a pipsqueak Western-driven version from 45 years ago. No, this one involves the entire world and wealthier nations that are coming along like India and China, who have the biggest bullion appetites in the world in terms of overall ounces per year. They don't care if gold is at local nominal record price highs. For instance, India is buying still in heavy volumes to the tune of over 100 tons of gold last month, July 2024 alone. And I expect Indian silver importing to pick up back during the harvest and wedding seasons, our North American fall season. As you well know, every now and again, India imports over 50 million ounces of silver in just 1 month. Silver solar industrial demand figures are still climbing walls, sucking remaining silver supplies into deficits that will now be 6 years running in the entire global silver market. The underlying silver demand mismatch fundamentals are going to meet the spot price road at some point, sooner than later. And much of the coming silver shortage era will be largely due to decades of systemically rigged price signals globally. The aggregated shadow Eastern price for silver since 1970 has recently ballooned to nearly $400 an ounce. That is the same price chart, but in logarithmic format, so we can see the black intra-COMEX silver trading hours, starting all the way back in 1970 at $1.92.5 for silver per ounce. Remember that number, because it's going to help explain how silver market eventually gets back into equilibrium in the future. You see, without outsized derivative paper price slamming during COMEX hours keeping spot silver price discovery markets suppressed, especially since the 2020 COVID crash, well, the red spot price line would have already been ramping up walls. But this situation is going to change, again, as it always has. Phony price signals and fraudulent derivative leverage out-trading the underlying fundamentals eventually have blowback eras. We're moving and bumping back into one of those now. We're rapidly dwindling available silver supplies to the tune of another near negative 300 million ounces deficit this year in 2024 in a global market that supplies about 900 million ounces a year, being hit by demand near 1.2 billion ounces annually and growing. This coming fifth era of silver price equilibrium awaits the market. And when that time comes, it will be time to offload some silver winnings and move elsewhere with some of that wealth. But we're far from it now. Rather, this is the time to be getting positioned if you have not already done so. Basically, that black-colored COMEX line has flattened of late, but what we will eventually see again is it turning up into a building silver bull market. Here is that same COMEX silver trading black line close-up throughout this full fiat currency era. Since 1970, starting at $1.92.5 an ounce, the silver price within COMEX has dwindled down to 15 cents an ounce over the last 54 years running. You might need to hit pause and listen to that again and think that one through. This is the most crooked COMEX market, and that's saying something. But there are eras where silver future long bettors do in fact win over and over versus COMEX silver shorts, and it results in this blue line running up a wall. All the way back to the starting line of $1.92.5 an ounce for silver intra-COMEX hours back when it all started in 1970. When that happens, that is when silver is in a bull. My contention is when this repeating phenomenon reoccurs, it will likely be at or nearing the coming peak of the silver bullion bull market mania ahead, most likely at multi-triple digits per ounce silver spot price points, where the Eastern blue and red spot price line converge for the fifth time. That's many years and many multiples in price from where we are now. That's going to be all for our weekly SD Bullion market update. And as always to you out there, take good care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.